أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله صلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. So we are in the middle of chapter 11 inshallah. We are going to continue our discussion. We discussed the client side as well as the test of controls, and now we are going to discuss next the substantive analytical procedure and the substantive procedure. Our plan is to finish chapters 11 and chapters 11 and 12 before the spring break. So we have this week and next week before the break, and there is a quiz on chapter 11 next Tuesday, March 9th. Chapter 11 was not included in the midterm, and chapter 11 is also not included in the final. But there is a quiz by itself on chapter 11, only chapter 11, and your simulation will also test your knowledge of chapter 11. Okay, so it's important for you to understand it well. All right. Now, we have the substantive analytical procedures and the substantive procedures. Okay. Let's just jump into it. So we have the substantive analytical procedure right before the substantive procedure, and substantive analytical procedure require us to do certain testing of the financial statements before we jump into the test of details. And just to give you an idea, let's take a look at a financial statement, a real financial statement. Are you seeing it? Do you see the financial statements? Do you see it on the screen? Okay. So now follow my arrow. Here we have a real financial statement from a Domino's pizza store. This is a real statement that I got from my previous firm where I used to work. And if you come down here and if you look at the two numbers here under cost of goods sales, cost of food sales, this is the cost of goods sold, so they call it cost of food sales. And the first number is 433,000 and the second number is 355,000. Do you see those two numbers? 433 and 355. See my arrow? Do you follow it? Okay. Now, this 433,000 number is for 2020, right? And this 355,000 is for 2019. Now, is there a big difference between these two numbers? Is there a big difference between these two numbers? There is a big difference, right? Now, as an auditor, when we are looking at these financial statements from the surface, before we go into the depth to do the substantive procedures, we want to know why the number is different. we cannot necessarily find out at the substantive analytical procedure the reason of the difference. But when we see a big difference like that, we keep that in our mind. So we compare this year with last year's. We also compare the percentage, right? So you have 33.58 and 33.62. Are these two numbers different? The percentages, the cost of goods sold percentage, are they different? Is there a big difference between 33.58 and 33.68? Not much, right? That means that the sales, if you go up, increased in 2020 compared to 2019. The sales was 1.2 million in 2020 and it was 1 million. So 0.2 million, which is 200,000, in excess of 200,000, it increased. It's a big amount. So our question now is, why is that difference? And because I know from my discussion with the accountant who's responsible for this, the reason is because of COVID-19 in 2020, the businesses that delivered food, like Domino's, this is a Domino's Pizza financial statement, their business actually increased because people were not eating at the restaurants, sit down and eat restaurants too much. They were ordering. So their business actually increased, and that's why there is a big difference, right? So by looking at the financial statements on the surface, we do two things. First, we compare this year's with last year's, and we also compare this year's with the industry data. Now, how do we compare that with the industry data? We have, as auditors and accountants, knowledge of the industry. We have knowledge of the industry data. And from my experience, the cost of food sales or the cost of goods is around 30 to 32%, right? Approximately 32%, 32, 33. So it's not too much out of line compared to the industry data. Are you following? So this is to give you an idea of what is involved in the substantive analytical procedure. When we are doing the substantive analytical procedure, we are not going into the detailed documents, the purchase orders or the receiving reports or the sales orders or the shipping documents. We're not dealing with those. We're just looking at these numbers on the surface to see what is the pulse of the financial statement, what is the blood pressure of the financial statement. Do things look okay on the surface? And this would definitely, right, this big difference would definitely raise a question in our mind, which we are going to try to answer when we do the substantive procedure. I gave you the answer because I know the answer from the investigation. Do you follow? But generally, when you're looking at a big difference and you see something unusual, you would not know the answer immediately most of the time. So you would keep this in mind and you would take this knowledge when you do the substantive procedure. Is that clear? Are you following the idea? Does that make sense to you? What we mean when we say substantive analytical procedure, right? We are not looking at the details yet. We are just taking a look at the information on the surface. So let's go back to our slides. And here is the substantive analytical procedure for the purchasing process, which is chapter 11 that we're studying. So what we do here, we compare payables turnover and days outstanding in accounts payable to previous years and industry data. So what is accounts payable turnover? The days, the number of days it takes the client to record the payable and pay the payable. So let's say the client purchased something, they would debit expenses and they would credit accounts, credit accounts payable, not receivable. So they would credit accounts payable. When they make the payment, they would debit accounts payable and credit cash. So the time difference between crediting the accounts payable when they make the purchase and debiting the accounts payable when they make the payment, that is called the turnover, and it is measured in number of days. So let's say generally the client last year took 7 days on an average to buy something and pay for that item. And the industry average is also 7 days. But this year, let's say it took them longer time. It took them 10 days or 14 days to make the payment. So that's a question mark for us, right? And we do all of this to make sure to see whether there is an under or overstatement of the liabilities or expenses, right? We all of these procedures are as analytical procedures are done to see, is there a possible error in the liabilities and in the expenses? Is there something wrong? It is possible that nothing is wrong, right? And we usually cannot answer that question until we do what procedure? We cannot answer whether there's something wrong or is there a different reason. We can answer that question in which procedure, in which step of the audit? In the substantive procedure, right? In the test of details. So these are question marks, right? Just like the question mark we had in the financial statement of Domino's that we looked at. Are you following? Are you with me? Okay. Then we look at the next, comparing current year balances in accounts payable and accruals with prior year balances. And now we look at the accounts payable balance this year, compare that with last year. And accruals are other payables such as salaries payable, rent payable, electricity payable, all of these payables we look at this year and last year. And if they are close, that means there is no red flag, there is no question mark in our mind. But if they're big, there are big differences, right? Just like we saw in the cost of food sales, there was a big difference, right? Then we would put a question mark in our mind and say, is there a reason for it or is there an error? Okay. The next we look at, compare amounts owed to individual vendors in the current year's accounts payable listing to amounts owed prior year. So the client would give us a list of all accounts payable by supplier. So let's say the client purchased from Al Rayyan Water Company and the payable last year was 10,000 rials. And if this year the payable is 9,000 rials, not a big difference. But last year it was 10,000, this year it's 20,000. So now the question is, why is this? Is this correct? Is there a reason for this? Did they make too many purchases this year? Or is there an error? So we are after errors. So these questions, these investigations would raise question marks in our minds. Are you following? So you're getting an idea about the substantive analytical procedure, right? The substantive analytical procedure is taking the pulse of the financial statements to see, is there a possibility of an error? We don't know for sure, but we bring this question in our mind and we go to the substantive procedures with these questions in our mind. Okay? These are the questions Sharat asked, are these done through observation? These are done by looking at the financial statement, just like we looked at the financial statement, right? On the surface, we don't look at documents like sales orders or shipping documents. We don't do that. We just look at that 1 page or 2 pages of the financial statements which give you that data, right? And they're usually presented side by side, just like the one we looked at, right? You follow? So that's how we get the numbers, right? So for example, if you're looking at accounts payable, right? If you're looking at accounts payable in the same company, right? Let's go to the financial statement. If you go there, you see the accounts payable, right? You see that, Sharat? These numbers, right? Accounts payable food vendor, accounts payable beverage. So this is the accounts payable for this year, right? Food vendor, 47,450. So this is where they buy the food from. This is where they buy the drink from, right? We look at these numbers and we look at last year's to see, are these numbers close or are they very different? So it doesn't take a lot of time. You can do it in 5 minutes, right? Give you a pulse. Is that clear? Okay, because some numbers are crossed out because these are real financial statements and they're confidential, so we know the numbers, but we don't know exactly which company it belongs to. We know this is a Domino's Pizza store somewhere in Mississippi, but we don't know exactly where it is because these are confidential numbers. These are real numbers, and my boss gave them to me, and he also delivered a talk in the MBA class. I have a recording of that, and if you're interested, I can give you access to his discussion of these financial statements. So he went through the financial statements and discussed them. He is, working in that company, in that firm for 30 years. I worked there for about 8 years. So, he has vast knowledge of this, and he gave a virtual talk. He was in my MBA class talking about these financial statements. If you're interested, I can give you access, right? So these are not scanning documents. No, these are not scanning documents that are referred to in Chapter 8. This is analytical procedure, substantive analytical procedure. Scanning documents, there are documents such as minutes of the meeting. There are documents such as officers' notes, things that the company has, board meetings, etc., where they have recorded what they discussed and so forth. So those are scanning of the documents, right? They are not many, and you don't sample in doing those. Okay. All right. That's a very good question. Okay. So now here we are done with the third one. The last one of the substantive analytical procedure says compare purchase returns and allowances as a percentage of revenue or cost of sales to prior years and industry data. Now, the returns, the purchase returns, right? They're usually shown on the financial statements. If there are any purchase returns, they're shown on the financial statement as a percentage of the sales. So let's take a look. We don't have a purchase return on the financial statement that we just looked at. So I'll show it to you. As you see here, we have on top left side, do you see my arrow? It says sales, 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 sales. Do you see that on the top left, right below revenue? Okay. You see right below the sales, there is a line that says refunds, right? You see that? Refunds, yeah, that is the sales return. That is sales return. So these are refunds, sales returns from customers, right? Sales refunds. Now, if you come all the way to the right, you see in 2020 it was $7.62, and in 2019 it was $76.27. This is 0% of the total sales, right? Total sales was 1.2 million, and if you do a calculation, it becomes, if you round it to two decimal points, it's 0. And this, if you round it, it's 0.01. You see, sales refunds, sales returns, and refunds, same thing. Something we need to worry about? Do you think this is something that we need to concern ourselves as auditors? Is there a big issue in this? $76 and $7? No, right? Similarly, if you come down to the cost of food sales, which is cost of goods sold, you have purchase, 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 purchase. Do you see that? Right below the purchase, if there was a purchase return, then it would show up right here, right before delivery. But there is no purchase return. Do you see? For this company, there is no purchase return. Are you following? So this tells you that this is not a big deal. This is not a big issue for the most part. So the analytical procedure says that compare the purchase returns and allowance as a percentage of revenue, right? The sales return percentages you saw 0.01% and 0.01% and 0.00%, right? Now, Motasim said, but the change is huge compared to last year. You mean the difference between $7 and $76? Is that what you mean? Right. So mathematically, yes, it is a big percentage. But my question is, you're dealing with a company that makes a sale of $1.2 million, and let's say the whole thing is wrong. Let's say the $76 is wrong, right? Is that something that you can worry about as an auditor, given you get paid $150 for doing your work for an hour? Can you spend any time looking for $76? If it is wrong, is that going to make a big difference in $1.2 million? No. This is what we mean by materiality. It is immaterial, meaning it doesn't matter. If the whole thing is wrong, no big deal. $76 will not make any difference. It will not change the decision of any investor, right? You follow? If we are talking about large numbers, and large number is a relative thing, you follow? Large number is a relative thing. When we're dealing with $1.2 million in sales, we cannot be worried about $76, right? You follow? Is that clear? Right. So now the purchase returns, again, it's not very common to have purchase returns, but if they do, then we need to investigate that. All right. So is this clear, the idea of the substantive analytical procedure? The idea of the substantive analytical procedure, what we are into, what we're trying to do, what numbers do we look at? Okay. All right. Very good. Now we get into our favorite substantive procedure. Substantive procedure is the audit. Substantive procedure is the heart of the audit. We do everything until we come here so that we know how much of this we have to do. Now, we are not worried about occurrence in accounts payable because the client would not record an accounts payable that did not happen. Accounts payable is a liability and it's not something that is good. So you don't have to worry about the occurrence as an auditor that much. We start with the completeness. We worry about unrecorded liability. So there is a liability and the client did not record it. Now we are worried about that. So what do? Reconcile vendor statements to accounts payable records. Vendor statements are documents that come from the supplier that show how much inventory the client purchased from the supplier in the previous month and how much of those were paid. So if there were any unpaid purchases, that would equal to the accounts payable in your client's records. So you have two documents that showing the accounts payable, one from the supplier, which is a third party, and one from your client's documents. If we reconcile them, if they match, that means the client recorded the accounts payables completely. Okay, does that make sense? Do you follow the two documents that are coming from two different sources? Are you following? You can also confirm the payables with the supplier. So you can send the suppliers a confirmation, and we're going to talk about it at the end of the chapter in a few minutes. You can ask the supplier about the payable, and the supplier can confirm the payable. And how we do that, we'll discuss it. Although this is not very common, but it can be done, right? The next is match payments to vendors for a limited time after the year to accounts payable. So if there was an accounts payable on December 31st for $5,000, and if you look into the financial statements or the general ledger of January and you see a payment to the same supplier for $5,000, that means that that accounts payable that was recorded in December is correct. If you find a payment in January to a supplier and you do not see a payable for that in December, that means that payable was not recorded. So you can look at the payments made to some suppliers after December and compare that with the payables recorded in December, and it will tell you that the payments were recorded. You get the idea of this test? Do you understand what we're doing here? All right, very good. And then we examine files of unmatched purchase orders, receiving reports and invoices to find unrecorded liabilities. Every single purchase order should have a receiving report and an invoice. Remember, the order of the document is purchase order, which is done by the client, which is prepared by the client and sent to the supplier. Then we have the receiving report, which is also prepared by the client, and it is prepared when the goods are received. And then the invoice, which is either coming with the shipment or after the shipment, which is from the supplier. Every single purchase order should have a receiving report, it should have an invoice, and they should all match. If you find that one or more of these documents are missing, that means maybe something is not recorded. And I showed to you the other day in the other lecture, and you saw, maybe you didn't see the recording, but let me show it to you. Here, this is a voucher register. All right, you see that voucher register? You see the voucher register on the screen? Okay, so you see here, there is a voucher packet, the first one. It has a purchase order, which is purchase order number 701, and the amount is $9,231. For the same, you have a receiving report. The receiving report number is 345. The amount is the same. And then you have an invoice, which is coming from the customer, the vendor of the client, which is 9,003, and the same amount, right? And the payment was also approved for the same amount. So when you have all three of the documents present and everything is matching and so forth, that means the liability was recorded. But if you find some discrepancies, some numbers are not matching, or there is something wrong with the amounts and so forth, then maybe there is a misrecording. Maybe it was not recorded properly. Does that make sense? Okay. It's a question from Ali. It says, if the client has an estimate of AP, what do we do with that? What do you mean by estimate of AP? APs are real, right? You record an AP when you purchase something. There is no estimated accounts payable, right? If you buy something, then there is an accounts payable. The purchase order shows how much the item that you ordered is. So it comes from a price list, and you know what the accounts payable is. Does that make sense? If they expect an AP in 2021, what does that mean? Something that you did not purchase yet? Something that you did not purchase? Can you hear me? Ali? Yeah, sure. They give you access. Go ahead, Ali.
Oh, can you hear me?
Yeah, go ahead.
Doctor, in accounting intermediate 2, I remember we do when a company maybe has when it's maybe for example it's going into court And they expect to lose the settlement, and they expect to pay like maybe $500,000.
That is called, I got your point. That is called the
Yes.
contingent liability. That is not
Yes.
accounts payable.
Do we
Contingent
record it?
liabilities,
Do we
contingent
think about it?
liability, contingent liability, Ali, has three different types. One is probable, the other one is possible, the other one is remote, if you remember. And in each case, the ruling is different. So this is not, by the way, accounts payable. Accounts payable is with the supplier, and we're talking about accounts payable. Contingent liability is if there is a court case, and if you think that you're going to lose the court case for sure, then you record a payable, but this is a different payable. This is a contingent liability payable, meaning that if you lose the court case, you have to pay, and you are almost sure that you will lose the court case, right? So this is a different animal. Are you following?
Yes, doctor.
If you think that you're not going to lose the court case, right? You'll win it. You don't have to do anything. If there is a 50-50 chance, you don't know. Maybe you will win, maybe you will lose. Where does it go? Let me test your knowledge on this. Where does it go? If it's 50-50, where does it go?
If it's 50-50?
Yeah. You don't know. Maybe you will win, maybe you will lose.
Don't record anything?
It goes into the footnote disclosure.
Yes.
Remember? So that's a different animal. That's a different beast. That's not accounts payable. Accounts payable are you're buying things and you're paying, right? So you don't have an accounts payable unless you bought something. Is that clear?
Yeah, that's clear. But as auditor, do we look at those accounts?
Yes, we do. But
So
that's a different.
how do you react to it?
We will come to that.
Okay.
We have disclosures. We will come to that. Okay. We will go to that type of payable in just a few minutes, inshallah. Sharad says, wouldn't ignoring the occurrence assertion be risky, like the accountant might record a fictitious payable to his own vendor or something? This is unlikely, right? Over recording of payable is not a good thing. So you are worried about over recording of accounts receivable, but you're not worried about over recording of accounts payable because it looks bad on your financial statement. So this is something. Now you're talking about a particular situation when there is fraud, right? And there are other procedures to catch fraud. So for regular supplier payables, right, it would not, you don't have to go through this. And if you have a payable recorded and it's not paid, right, it's not paid over a long period of time, then your substantive analytical procedure would raise that flag. It's huge, long payable outstanding. Why is it there? All right. Does that make sense? All right. Now the next is accuracy. We compare the list of accounts payable with general ledger totals. The client would give you the list of accounts payable by supplier, and if you add those totals, they should be the same as the total in the general ledger. So we compare that to make sure that the items are added accurately and all the items add up to the total. Also, we match supporting documents with a sample of accounts payable subsidiary ledger. So what is it? Subsidiary ledger is an accounts payable that you have for every single supplier. So when you look at the individual supplier accounts payables, right, for every single accounts payable there should be a purchase order, a receiving report, and an invoice. And when you take a sample of those and you match, you will see that the items are recorded either accurately or there are some errors. So you'll be able to catch that. And we go through the procedures to sample, and then we conclude about the account by finding misstatements and checking with our tolerable and so forth, right? Okay. Then we go to the next, which is cutoff, and we compare the dates of the purchase order, receiving report, and invoices with the dates of recording. The purchase should be recorded when the items are received, and if they're received daily and recorded daily, I'm sorry, if they're received and recorded the same day, if they're recorded daily, that means December's items would not flow into January. So daily is a powerful word, remember. The next thing we do also to check cutoff is the check of physical inventory and purchase return records. So physical inventory, right? Actually, do they have physically the inventory in the warehouse, and we can take a sample and look at that, or did they return it? So we can look at the purchase return records. And just a few minutes ago, we looked at the financial statements where we saw that purchase returns are not very common, right? Purchase returns are not very common. So while we do this procedure, but we may not find anything in the purchase return records because they may not have returned anything, okay, in this month of December. So the cutoff is usually done at the end of the month and the beginning of the month, end of December, beginning of January, when the cutoff period is. We want to make sure nothing in December was recorded in January and nothing in January was recorded by accident in December. So the cutoff is to check that, and it's easy to test. You just have to look at the last 2 weeks of December and the first 2 weeks of January. Is that clear? Then we go to the next assertion, which is existence. Matching a sample of items from accounts payable with supporting documents such as, again, the same 3 documents are coming up: purchase order, receiving report, and invoice. Again, there is some overlap between the two, cutoff and existence. Here, you want to make sure that they did buy the item. So by checking the existence, you are also somehow checking the occurrence as well, right? So you want to make sure that the items that they purchased are actually present, right? Near the end of the year, if the accounts payable is recorded, then you will have those supplies there. And if you have an accounts payable, by the way, recorded long time ago and they're not paid, that means there's something wrong, because the suppliers would get paid regularly on a monthly basis. And if there is a big delay, then this should raise a flag in your mind and you should do further investigation. All right. Then we go to the next, which is rights and obligations. Here, rights belongs to the assets and obligation belongs to liability. Now, the concern is the client recorded an accounts payable, but it's actually not their accounts receivable. And again, like I said, the client wouldn't do that because liabilities are not good things. So it's not a big concern for us. We're not worried about accounts payables recorded and it's not their accounts payable. Okay, not a big concern. Valuation and allocation is the next one. We test whether the accounts payable is recorded for the proper amounts net of applicable discounts. So we want to make sure that the accounts payable, if there are any discounts, let's say there is an arrangement with the supplier that says 210 and 30, and you see the client regularly taking those discounts and they have recorded the amount with the discount and the amount is payable, it's 7 days from the end of the year, no big deal, it's fine, right? If you see they have recorded the amounts with the discount. Okay, if they don't record the discount, that's also no problem. The discounts are not that much for 1 month, so we're only worried about the accounts payable for 1 month, or even it could be for 1 week, right? So we want to make sure the value of the accounts payable is recorded correctly. Classification and understandability. Find and reclassify material debits in accounts payable. The accounts payable account should either have a credit or it should be zero. There should be no debits, right? You should not pay the supplier more than what you're supposed to pay. So if there is a debit in accounts payable, then there is a possibility that it is an error. And the client should be given journal entries they will make to remove those credits, those debits away from the accounts payable to the right account. All right. Segregate short-term and long-term payables. Now, all accounts payables are short-term. If there are other payables like notes payable or officer payable or other payables, bonds payable that are long-term, they should be separated from the accounts payable, which are short-term. And then we want to ensure that different types of payables are classified properly. So now here, if we have something called a contingent liability or we have a court case going on, then that should be classified separately based on the ruling, based on what is the possibility of them losing the court case or winning the court case. And it should be classified based on how soon they have to pay. If they have to pay within 12 months of the balance sheet date, then it is short term. If they don't have to pay immediately, then it's a long-term liability. So all of those should be classified properly. Does that make sense? Are you following? Okay. Now, disclosures to look for. In addition to the presentation on the financial statements, there are footnote disclosures. And in the footnote disclosures, there are details provided on what's on the financial statements that cannot be put on the face of the financial statements. The first thing here you see, payables by type. Okay, so now all the payables, like trade payables, all accounts payables are called trade accounts payable. They're from suppliers. They should be separate from if there is an officer payable, or there is an employee payable, right? Maybe there is a court case going on between the employee and the company. So that should be reported separately, right? And it should be disclosed in the footnotes as well, that what happened, why is there a court case. And usually these things are out also in the newspaper, right, for big companies, so people would know about them. But the company's responsibility is to provide as much details as possible in the footnote disclosures. Number two, long-term purchase contracts. If the company has made a contract with a supplier to buy certain items for a certain period of time, so let's say the company has made a contract with a supplier to buy water from them for the next 2 years for a certain price, this should be disclosed in the footnote disclosures. The investor should know about them. If there is any unusual purchase commitment, anything that is not normal in the industry, right? Maybe they have a contract with some suppliers to buy certain things for a long period of time for a particular price, and the price is unusual and the terms are unusual, those should be disclosed. Okay. Similarly, purchases from and payables to related parties. So here, Sharat, if there is an accounts payable to a related party, meaning the company has a subsidiary or the company has a supplier who is a relative of the CEO or a relative of the president of the company, that those are related party transactions. Those should be disclosed in the footnote disclosure. Okay, so that investors know that there is related party transaction going on. Okay. Dependence on, number 5, dependence on a single or small number of vendors. So if the company has made or the company regularly purchases items from 1 or 2 suppliers, then this should be disclosed, because if something happens to those suppliers, their raw material supply temporarily would stop. Like what happened to us in 2017, we were buying all our milk from Almarai, and when the supply stopped, right, we were in temporarily, at least, we were in a little bit of a difficulty. Do you remember that, right? So we had milk coming from another supplier, and it were almost expired by the time they came. Do you remember that in 2017, initially, before we alhamdulillah came up with our own baladna? So if the company has a policy of buying the items temporarily from a small number of suppliers, then this should be disclosed. Number 6, cost of reportable segments of the business. If the company has costs by reportable segments, so if the company has a segment that makes computers, another one making televisions, another one making tablets, another one making digital watches, these should be reported separately. They should be reported separately, because the investor has the right to know where they're making money and where they're losing money. Remember that in cost and also in managerial accounting, the segment reporting, right? When we make a decision whether to continue or discontinue a business segment, you report the income and loss from each segment, so that the investor knows that, okay, there is a loss from the digital watch segment. Does that make sense? So it should be reported properly in the financial statements. All right. Now, Coming back to the confirmation of accounts payable that we said, unlike the accounts receivable confirmation, the confirmation of accounts payable is not done frequently. It is not a normal procedure because accounts payables, right, should be paid regularly, and you should be able to confirm them by looking at the payments. However, if you choose to, in certain circumstances, do the confirmation, then the confirmations are sent positive, meaning you want a response, and they're usually blank. So you put in the letter to the supplier that our client has an account with you. Can you provide us with the amount payable as of December 31st, 2020, let's say. So the supplier would respond that the payable for December 31st, 2020 is 10,000 reals. So you can compare that with the client's financial statement. So this is how the confirmation of AP is done. Not common, but you can do it if there is a need. All right. So this brings us to the end of chapter 11, and I gave you a lot of information, and you have between now and next Tuesday to study chapter 11 for the quiz. There is no the chapter 11 was not included in the midterm. It's not included in the final. So the quiz is going to test your knowledge, and you're also going to be tested in the audit simulation that you're going to do in April, inshallah. So chapter 11's knowledge will come in handy, but chapter 11's knowledge is not the only thing you would know for the need for the simulation. You would need other knowledge from other chapters as well, and we will build on that slowly, inshallah. All right. Any questions? Are you following? Are you getting an idea of the audit procedures? Are you getting a hang of it? Okay. Now, since midterms are over, for the most part, hit the simulation that I gave you. Get into groups, or if you venture to do it individually also, no problem. It will enhance your understanding. Okay. All right then. Have a good day, inshallah, and I will see you on Tuesday. Assalamu alaikum wa rahmatullahi wa barakatuh.